In this video, which is going to be a short one, we're going to look at the effect of taxes on our wage setting and price setting model. That's one of the things that we haven't talked about, right? We talked about, things that require taxes, things like unemployment benefits or a wage subsidy. But we didn't really say, all right, well, how does the government get that money in order to pay those benefits? And so in order to do that, we're going to use a little bit of math, but we're not going to sort of focus too much on the math. Really what we want to do is just see what happens in our model. And then we can actually think about that in terms of not only just taxes, but anything that increases costs for firms, such as higher costs of energy or higher costs of imports. So let's get into it now. We can look at sort of two types of taxes, right? So one very common tax in Europe is a consumption tax or a value-added tax. And so what that's going to do is to increase the consumer price, right? So here, TV is our consumption tax or value-added tax. And that gets added to the price, and that increases the price that the consumer has to pay. Now, another very common tax, basically in all developed countries, is the income tax. And so if we think about the sort of gross wage, that's going to be equal to W times 1 plus what we're calling TD for the income tax. And what that's going to do, both of these taxes, right, since the consumer has to pay them, the worker consumer has to pay them, is going to decrease the real wage. The income tax decreases your amount of disposable income, so that decreases your real wage directly. And the consumption tax makes prices more expensive, and so because prices are in the denominator of the real wage, that decreases the real wage as well. And so here's our sort of formula all put together. Let's just look at what this means. Our real wage, lowercase w, or maybe it's a lowercase omega, is equal to the average product of labor, that's lambda, times 1 minus the profit margin, right? That's sigma. So the example we've often been using is 40% profit margin, or maybe 30% would be more reasonable. And then we divide that by 1 plus the income tax times 1 plus the consumption tax. And so they've done some examples here where the consumption tax is 20%, the income tax is 25%, and sigma is 40%. And you can see that that shifts down our price setting curve, right? And so that is going to increase the unemployment rate and decrease the real wage. And so that's the takeaway. That's really all you have to know, is that when taxes increase, whether those are consumption taxes like a value-added tax or a sales tax, or income taxes, right, that is going to shift down our price setting curve, and we're going to move along the wage setting curve to a higher rate of unemployment and a lower real wage. Now, that says, okay, tax is bad, right? We should get rid of taxes. We shouldn't have any taxes. But obviously we need some taxes. Taxes get spent on things that actually increase our productivity, right? Things like training and education. So, if we think about K through 12 education, that's all paid for, or almost all paid for, through taxes. And a lot of our higher education in the United States, and almost all of the higher education in other countries, is also paid for through taxes, which makes workers more productive, which we saw before is a thing we want to do. Taxes also pay for infrastructure like roads, trains, electricities, airports. Those things increase productivity as well. And so those would shift up the price setting curve. And so really it's a balance of trying to figure out, okay, well, how much of our spending will shift up the price setting curve and increase real wages and decrease unemployment? And how does that balance with the fact that just imposing those taxes shifts the price setting curve down? Now we can also think about this in terms of imported materials or any sort of increase in the price of inputs. And so the example they're talking about here is energy, right? Which we can model as an increase in taxes. But it's not only energy, right? So energy was a big example in the 70s, and of course it's still a big example. But also, things like putting tariffs on steel or aluminum, right? That increase those prices. And either way, that shows up in the denominator of our real wage. And so our real wage goes down, the price setting curve shifts downward, we get a lower real wage and higher unemployment. And so we saw this in the United States in the 1970s, where we had, two big energy shocks where the price of oil went up, and we ended up with higher unemployment and a stagnant, real wage. Real wages started to fall because of that higher inflation. And it was really because of P going up rather than nominal wages going down. And I think that's really important to remember, right? Is, the real wage is both the nominal wage and the price level. And so the real wage can fall if nominal wages go down, which doesn't usually happen, but they can also fall because the price level goes up. And the price level will go up when we have an increase in energy prices or an increase in any type of major input price as well. And so that's one risk with tariffs, especially tariffs on inputs like steel and aluminum, is that they increase prices and increase unemployment. All right, so in our last video for chapter 2, we'll look at some international examples and we'll think about sort of labor market institutions more generally and why different countries might end up in different places.